Hey everyone, welcome back to Corporate Decoder, the place where we turn complicated corporate filings into something you can actually understand. Today we're diving into a report from Fannie Mae. It's about some big changes at the top, and let's just say it's not exactly a smooth transition. You could say some people got the boot. This report is a snapshot of what happened on March 17, 2025. It's called a Form 8K, which companies file when significant events happen that investors should know about. In this case, it involves major changes to Fannie Mae's board of directors, which is like the company's leadership team. The main event here is a shake-up in Fannie Mae's boardroom. The Federal Housing Finance Agency, or FHFA, which is basically Fannie Mae's conservator, meaning it watches over them, decided to remove several members from the board of directors. Think of it like the government stepping in to rearrange things. Specifically, 8 directors were removed, including Amy Alving, Christopher Brummer, and several others. That's a pretty big sweep. However, not everyone was shown the door. Priscilla Almodovar, Renee Lewis Glover, and a few other members are staying on the board, so there's still some continuity. To fill those empty seats, the FHFA appointed 4 new directors: Clinton Jones, William Poulter, Christopher Stanley, and Michael Stuckey. This means a completely fresh perspective is coming to the table. And here's a key detail. William Poulter will be the new chairman of the board. That's like being the captain of the ship, setting the overall direction. These new directors' terms are temporary. They'll serve until the next annual election, or if the FHFA decides to remove them sooner. Basically, their positions are not set in stone. Now, the report mentions that they haven't yet figured out which board committees the new directors will be on. Board committees are small groups within the board that focus on specific areas like risk management or compensation. Also, they haven't determined if there are any special relationships or transactions that need to be disclosed. They promise to update us on this later. For 2 of the new directors, Mr. Stanley and Mr. Stuckey, their pay will be the standard director compensation. This information is actually detailed in Fannie Mae's previous annual report. It's all publicly available. You can find details about this pay in the section labeled Executive Compensation of their annual report, which was filed back in February. Finally, Fannie Mae plans to sign agreements with the new directors that protect them from certain liabilities. It's a standard practice called an indemnification agreement, which is a fancy way of saying the company will cover their legal costs in certain situations. Now, let's zoom out and think about what this all means. Fannie Mae plays a huge role in the housing market, helping people get mortgages. So when there are big changes in leadership, it's worth paying attention. The FHFA removing so many directors at once suggests they want to shift Fannie Mae's direction significantly. Maybe they're not happy with the current strategy, or perhaps they see new challenges and opportunities on the horizon. The appointment of new directors brings fresh perspectives, but also introduces uncertainty. It takes time for new board members to get up to speed and for a new chairman to set the tone. This could lead to some short-term instability. One potential risk is that these changes could disrupt Fannie Mae's operations and affect the housing market. On the other hand, it could also lead to positive changes like better risk management or more innovative strategies. Overall, these changes at Fannie Mae's board are a big deal. They signal a potential shift in direction and introduce both risks and opportunities. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe for more insights into the world of corporate filings. What do you think about these board changes? Let me know in the comments below.